Hi, my name is Nicolene Hamaty and I'm the National Trading Manager for Century 21 South Africa. Today we are going to answer a frequently asked question, and that is, do I have to pay tax on my rental income? Now let's first look at what is rental income. If you rent out a property, generally residential accommodation, and you receive rental income, then yes, the amount received will be subject to income tax. Residential accommodation can include holiday homes, bed and breakfast establishments, guest houses, or renting out a section of your home, for example, a room, garden, or granny flat, and any other dwelling similar. Now that we know we need to pay income tax on rental income, let's look at how that tax on rental income is calculated. The rental income you receive should be added to any other income you may have received. You can, however, reduce the rental income amount by certain expenses that are allowed by SARS. If you receive any other income in the total rental of your property in addition to your monthly rental, then these amounts will also be subject to income tax. These additional amounts of income received can include, for example, rental that is paid in a lump sum at the start of the lease, in which case the full amount is subject to tax in the year of assessment during which the income was received, not when the rent was due. The rental deposit, however, does not need to be included in the landlord's gross income at the stage it was initially paid, if there's still an obligation to the landlord to refund that deposit at a later stage. The deposit generally only becomes gross income when the deposit is applied to the landlord. In other words, you retain the deposit either for damages or rent not received. Now, can you reduce the rental income? Yes. The rental income may be reduced by any of the expenses that are permissible that occurred during the period that the property was let. But only expenses that occurred in the production of the rental income can be claimed, and any capital or private expenses are not allowed as a deduction. Now, which expenses are permissible? Well, rates and taxes, bond interest, advertising, estate agency fees, insurance, but only homeowners insurance, not household content insurance, garden services, repairs into respect of the area that was let, security, and property levies. Now, which expenses are not allowed? Well, any expenses that are capital in nature or that are not in the production of the rental income will not be allowed. This can include, for example, costs for improvements made to the property. Now, improvements should not be confused with repairs and maintenance, which are allowed as a deduction. Repairs and maintenance are when you attempt to restore your property or asset to its original condition because of damage or deterioration. Improvements would usually result in the creation of a better asset, in other words, upgrading your asset or your property. Now, while improvements are not allowed as a deduction against rental income, the value of the improvement can be included in the base cost of the property to effectively reduce the capital gain or loss when you sell the property and when it comes to capital gains tax. Now, always remember to consult your tax professional before using any information provided by an external party, including this video. I've included a link below for you for more information from the SARS website. Till next time.